Good morning, everybody. How are you all doing today? Good? Great. As usual, nice to see everybody here. We're going to talk today. This is our fall 2013. Do you believe it's fall 2013 already? This year kind of went by fast, didn't it? So we're here at the fall 2013 workshop on irrevocable trusts. Is everybody excited about that? Wow, just an exciting topic today. At the end, today is kind of a precursor to what we're going to do in the spring. So pay attention. Put your thinking caps on. Usually we like to make these workshops fairly basic, but today and the spring one, I'm warning you, are a little more complex than normal. So put your thinking caps on. Write down your questions on your slide handouts, please. And you can ask us the questions at the end if you have any. And then we'll take a few from the audience before we say, okay, that's it. And then for those of you who want to stick around, we can do a little round table. We'll pull a few chairs in a circle. Those of you who have more complex questions or want to ask something a little bit more, we can do that for several minutes afterwards as well. The main topic today: what are the differences between revocable trusts that many of you already have, almost all of you who are our clients, and by the way, for those of you who are not our clients, just invited guests, my name is Craig Hirsch. I'm a board-certified wills, trusts, and estates attorney. I'm also a CPA. I don't practice as a CPA. I practice exclusively as an attorney. I'm here with Michael Hill, who's also board-certified in wills, trusts, and estates, one of my law partners, and as well as Blake Hampton, who's manning the camera there for our DVD, and Blake is an associate in the firm. But what we're going to be talking today about are the differences between revocable and irrevocable trusts. And as I just mentioned, almost all of you have revocable trusts. Now, someone mentioned me beforehand, I think it was Bob, mentioned to me beforehand, asked me, well, do we still need a revocable trust now that the estate tax exemption is $5 million plus? Revocable trusts, they're still important for us, even with a high estate tax exemption. Just to refresh your memories, revocable trusts help us in the event of our incapacity because our successor trustee steps in to help do the things that we would normally do for ourselves if we can no longer do them. It's a lot easier to use than, let's say, a power of attorney. Revocable trusts help set up sub-trusts that we're going to talk about today for our beneficiaries to protect it from creditors, and divorcing spouses. Okay? Revocable trusts do still have some income tax planning elements to them. We'll talk about that today too, with irrevocable trusts and how that kind of plays with each other. So there's still a lot of benefits, and I don't want to spend too much time on that today because that's not the topic of today. But the elements of revocable trusts is that they can be amended or revoked. You can change them. So if you want to change who your trustee is, you want to change who your beneficiaries are, you want to change how your beneficiaries receive, you can make those decisions and change your revocable trust at any time. You just have to sign a valid amendment, right? Yep. So a revocable trust can be changed. Revocable trusts are also income tax neutral. What do I mean by that? What I mean by that, and this is real important because estate planning is going less and less from estate tax planning, by the way, because of the high exemption, so long as they remain with us. But estate planning has really become more of an income tax planning game, and even more so with the Obamacare, Medicare surtax that we're going to touch on lightly at the end of today and focus on in our next presentation. But revocable trusts are income tax neutral. What that really means is it doesn't change. If you have a revocable trust during your lifetime, it uses what as your taxpayer identification number? It uses your Social Security number, right? So it doesn't file a separate tax return. To the IRS, it's as if it doesn't exist. Does that make sense? So during our lifetimes, our trusts are tax neutral. They don't help us, they don't hurt us. In a revocable trust, as the grantor, you own the assets, right? You could do whatever you want with them. You could spend every last dime, you could take an around-the-trip cruise, you can buy that Lamborghini you want. You could tell your kids they're not going to get nothing from you, right? You can do whatever you want with your assets in your revocable trust. And revocable trust, because you can do whatever you want with your assets and because you have so much control over them, they don't offer any creditor protection for you. For you. But we'll talk about what happens when you pass on and you leave your trust to others. So now we'll talk a little bit about the differences between revocable trusts I just described and irrevocable trusts. Or is it irrevocable? Who says Caribbean? Who says Caribbean? I just took a Caribbean cruise. No, you didn't. You just took a Caribbean cruise. Well, I don't know. I usually say irrevocable. But is that because I'm from Indiana originally?
It's irrevocable.
Or is it irrevocable? Okay. How many people say irrevocable?
It's like Missouri and Missouri.
Yeah, how many people say irrevocable? Anyway, I may switch between the two to appease everybody today. So irrevocable trusts cannot be amended, generally cannot be amended by you once you've created them and put something inside of it, once you've funded it. Remember we said with your revocable trust, you can change it. Once you've done an irrevocable trust, you cannot. It's set in stone. Irrevocable trusts are generally not income tax neutral. What does that mean? Usually they have their own taxpayer identification number, usually, although sometimes we can make the grantor also the person who pays the income tax on the trust even though they're not receiving the income. We can actually do that, and there are situations when you may want to do that. But generally speaking, irrevocable trusts are not income tax neutral. They have their own taxpayer identification number. That's going to be really important. Remember that for later slides, okay? They have their own, they're a separate taxpayer. The grantor of the trust in most irrevocable trusts does not own the asset any longer. Once you have transferred the asset into the irrevocable trust, you no longer own it. You don't control it. But everything that you put in the trust document says how it's to be administered and distributed. Irrevocable trusts do offer creditor protection to the beneficiaries, generally speaking. Not to you as a grantor, unless you're in one of these special jurisdictions like Alaska. Florida doesn't have a self-settled, irrevocable trust that protects your own assets from your creditors. But when you pass away and you leave those assets to your spouse, or you leave those assets to your children or even your grandchildren, as long as they continue on in trust, generally speaking, irrevocable trusts do protect and can protect the assets from their creditors. So with that said, I'm going to turn it over to Michael, who's going to talk more about when they're used.
Thanks, Craig.
All right, so when do we use irrevocable trust or irrevocable trusts? The issue is we only use them for a purpose. We only use them if we really, really need one of these benefits. And the irrevocable trusts are used mostly for some type of protection, whether it's protection from creditors, protection from spouses, whether it's creditors from in-laws for our children, whether it's creditors from the IRS, creditors from Medicaid and the state as far as long-term care. So we're setting up an irrevocable trust for a specific purpose. And so here are just a handful of the ones that are commonly used. The first one is protect lifetime gifts for our loved ones. And so we might make a gift outright to a child, and that exposes it to certain risks, creditors, divorce, bankruptcies, those types of things. So instead of making that outright gift to them, we put it in an irrevocable trust for them. So instead of getting the money, they get a trust that has the money, and the trustee's in charge of it and manages it, and there's any number of bells and whistles that we include in those types of trusts. But protection for our loved ones. Remove assets for estate tax purposes. That's a major one. For our clients that do have taxable estates, a lot of times we talk about making gifts and making transfers. And the estate tax, we have the alphabet soup of different types of trusts that we create. There's GRATs, GRUTs, CUPERTs, CRUTs, CRATs. I mean, there's any number of different techniques that we use, all really for the purpose of estate tax planning. I would probably say, for a lot of our clients, when we set up irrevocable trusts for you, estate tax planning is probably one of the #1 reasons why we do that. Now, when we talk about the kids, we're talking about lifetime protection, usually for the kids' irrevocable trusts. The next one, though, another common one, I'm seeing this a lot more in our practice, is we're trying to remove assets from our estate, not necessarily for estate tax purposes, but for Medicaid purposes and long-term care purposes, VA benefits purposes. Again, I can set up an irrevocable trust. We can get the assets out of your estate, still in control of the family or of our trusted loved ones, and then still be eligible potentially for VA benefits or Medicaid if that ultimately happens down the road. The next one is, again, if I've got I don't want to say a problem child, but a beneficiary that either has some issues, whether it's addiction or just spending habits, or usually it's the child who's married to somebody who has some type of issues, whether it's spending or what have you, but provide guidance as to how the assets are going to be distributed. A common example is, I just had a client a couple weeks ago. They want to provide for their daughter, but they want her to get $1,000 a month for the rest of her life, kind of as like a retirement. So we set up the trust, and we said the trustee is going to distribute X amount of dollars per month for the rest of her life or until the trust is exhausted. We wanted to make sure that she couldn't step in and blow it, basically, or do something that he didn't want. And so we want to provide clear guidance as to the use of the funds. We do this a lot with grandchildren. So sometimes we'll create like a grandchildren's educational trust where we want to put one child in charge of maybe 10% of our estate, and it's kind of a pool of assets for the grandchildren. So that if they can't afford college, or if their immediate family can't afford college, the trustee can make appropriate and certain distributions that we specify in the trust. So provide guidance as to distribution and use of the inheritance is a key. And then the last one, harmonize multiple generational use of a particular asset. Usually it's not of all of the assets. Usually it's that family compound or that family farm or the lake house. I want to make sure that if I have 4 kids myself, and if we have a property that I don't really want to be sold because I built the house or we've always enjoyed it growing up, a Sanibel condo or Fort Myers Beach condo is a classic example as well. There's certain peak times when it's up for grabs as to who might want to use that property, and so we can make sure that we're even-steven among the beneficiaries as to how they use that family property, and especially if we don't want it to get sold. So those are some of the reasons why we create irrevocable trust. Again, it's more than just the revocable trust where we're, like Craig said, probate avoidance and guardianship avoidance. We're talking about some kind of extra need or extra issue when it brings up irrevocable trust. Now, that being said, 2 different types of irrevocable trust, 2 major categories of irrevocable trust. The first one that I'm going to talk about are lifetime trusts. We call those inter vivos trusts, during lifetime. Something that you create now, an irrevocable trust that you create now and fund now with certain of your assets. The second type of trust that Craig's going to talk about is our testamentary trust, our death time trust, trusts that don't become irrevocable until we actually pass away. Okay, so 2 major types, ones that we set up during life and the ones that are in our estate plan that wait until our death to actually come to fruition. So common lifetime irrevocable trust. First, probably the most common that we set up a lot is our ILITs, our irrevocable life insurance trusts. Estate Tax Planning 101 is if I'm close to a taxable estate, if I've got significant life insurance, if I have incidents of ownership, if I'm the owner of a life insurance policy, even though it's income tax free, the death benefit is included in our estate for estate tax purposes. So I'm a perfect example. I've got a fair amount of term life insurance. God forbid I pass away sooner before my kids are grown up and those types of things. So I'm by far worth more dead than I am alive. But I would potentially have a taxable estate when I die just because I have all this life insurance. I don't have anywhere near $5 million of personal assets, but of life insurance, we've got several million of term coverage to provide for the family if I were to die sooner rather than later. So I can remove all of that life insurance out of my estate by setting up this irrevocable life insurance trust. Now, I'm not going to go into all the bells and whistles and all the nuances, but again, a common lifetime irrevocable trust is to remove life insurance death benefits from our estate. Okay, annuity trust. This is a great one, the one that I mentioned earlier, where the daughter gets $1,000 a month for the rest of her lifetime. That's kind of like an annuity, where I'm going to set up this trust. The trustee is going to distribute X amount of dollars per month or per year for the rest of their lifetime, and that's like an informal annuity. I don't have to go out into the annuity market and pay for an annuity and commissions and expenses and all those types of things. We can hold it all inside the trust. Charitable trust, where I'm trying to benefit both charities and the children. You know, they're CRATs and CRUTs and any number of different types of charitable trust where, yeah, excuse me, yeah, or ourselves, yeah, and this is the lifetime version. So yeah, I could create, and we do this on quite a regular basis too. If I've got a low basis property where if I were to sell it, let's say the northern house, it's worth $1 million and I paid $300,000 for it. If I were to sell it, I'd have the $700,000 capital gain. Instead, if I'm charitably inclined, I can create a charitable remainder trust, and I can contribute the house to that trust and have the trust sell it for zero capital gain. And then during life, I can retain a lot of the benefit. I can retain an annuity out of it, or I can retain a unit trust out of it, but I can get the tax deduction. I don't have to pay the capital gains, and I get an income stream out of it. So charitable trusts are excellent for my charitably motivated clients. Residence trust. This is a common one where we're in a second marriage. And actually I use this a lot for my unmarried clients who live together. And we say, okay, we're going to set up this irrevocable trust to hold the homestead. I'm going to contribute half of the expenses. You're going to contribute half of the expenses. When I die, it's held in trust for you, and ultimately my half flows back to my kids, and your half goes to your kids. So when we try to hold the homestead or any kind of jointly held property for somebody who's not married or second marriage clients. Gifting, I mentioned this earlier. If we're going to give a substantial sum of money to our children, one of the ways we do that is we hold it in trust for them. We call it a heritage trust. And I can make the child their own trustee. That's kind of the major benefit here. Assuming our children are trustworthy, instead of giving them $100,000, I can give them $100,000 in trust. They can be their own trustee. They're the primary beneficiary. They're deciding what investments and how to invest those funds. They are deciding when to take the money out. They're deciding where it goes when they die through what we call a power of appointment. So they really have effective ownership in the heritage type trust, but it's still not technically their asset. So if they get sued, if they get divorced, if they have a creditor problem, it's not really theirs because it's in a trust for their benefit. I mentioned this earlier too, the classic Medicaid planning, kind of the proactive Medicaid planning that we go straight to anytime somebody is not already in a nursing home, is my lockbox trust, a Medicaid asset protection trust, where we create a trust, an irrevocable trust. The kids are usually the trustee on that one, but it's outside of my estate for Medicaid purposes, and we go through all the planning there. Special needs trust is another great one, and educational trust I mentioned earlier too. So those are kind of just a quick rundown of the typical irrevocable lifetime trust that we set up during life for either you or for your loved ones. Correct?
To kind of build on what Mike just mentioned, a common scenario for a lifetime gifting trust to your kids may not be money or stocks or bonds, for example. It might be, let's say your daughter wants $40,000 for the down payment of her house, right? Maybe you create a trust to buy the house or use that $40,000 down payment rather than an outright if you're worried that she may be divorced from her husband who they're buying the house together and you're supplying all the money. That's just like a common example. Just wanted to mention that. Okay, question. We're going to take a poll. How many of you think, would the answer to yes be to do revocable trust ever become irrevocable trust? How many of you say yes? Many of you, yeah. How many of you say no? How many of you don't know and don't want to answer in front? The answer is yes. Many of you, in fact, have revocable trusts that will eventually become irrevocable trusts. For example, my trust at my death benefits my wife, Patty. At my death, my revocable trust, since I'm no longer around to change it, becomes irrevocable. Now, there's some back doors. I might give Patty a power of appointment, as many of you have given your spouses, to change the trust at her death. if one of our kids has a problem and she needs to change it, for example. Otherwise, it would go to our 3 daughters. And then when you have a trust that continues on for your daughters or sons or whoever, that may be an irrevocable trust too. It likely is an irrevocable trust. It goes on for the child's lifetime. Our revocable trust becomes irrevocable trust at our death. That is a testamentary trust, a trust at our death. What types of trusts are those? Well, I already mentioned one. One would be a marital trust. Another one would be a credit, shelter, or bypass trust for our spouse or our children. A special needs trust. When do we use those? That where I have a beneficiary who is receiving Medicaid or other government benefits, I don't want to leave a general trust to them, or I don't want to leave assets outright, because what's going to happen? They're going to lose their benefits, won't they? They will be disqualified from receiving whatever benefits they are receiving. And if what I'm leaving them is not quite enough to last them the rest of their life, I've done them actually a disservice, haven't I? So there's a way to deal with that by creating a special needs trust, or sometimes they're called supplemental needs trusts, for our loved ones who are receiving that type of aid. Mike already referred to a charitable trust. If I want a current income tax deduction, I have charitable intent, I want to avoid capital gains taxes, I might create a charitable trust during my lifetime. But I also might do it at my death. Let me tell you great assets to use for charitable remainder trusts. Your IRA and your 401k. Because what happens if I have a $400,000 IRA and it's popping out to one of my kids? What's going to happen when they take the money out? Taxable as income, that's right. Okay? But what happens instead if my IRA account dumps into a charitable remainder trust? Is that a taxable event? It is not. So now my charitable remainder trust has it. And let's say that my charitable remainder trust says pay 5% of its value to my children every year until they die, and then the remainder goes to charity. Now the 5% that they're pulling out is probably going to be taxable as income to them. Depends on a variety of factors, but probably going to be taxable income to them. But your estate will also get an estate tax charitable deduction, and if you have charitable intent, this is something that could satisfy that intent. And with your IRA, it's a good asset to do it with because of the income tax. Generation skipping transfer trusts. Many of you have these where your trusts go on for your children's lives and then your grandchildren's lives. Those are continuing testamentary trusts. These are good things because they do protect your children's inheritance from divorce and from creditors and predators. Some of you have kids who are in high-risk occupations. You know, they might be a lawyer, they might be a doctor, they might be an accountant. Why don't you get a laugh on might be a lawyer? It's a bad occupation now, I guess. So, you know, they might be in high-risk occupations. Those are the types of kids you don't want to dump assets out just as an outright distribution. Because if they're in the middle of a lawsuit, a malpractice suit, let's say, God forbid, they're in the middle of a malpractice suit, when those assets dump out to them, they can't transfer them into something that's protected. That's called a fraudulent conveyance. There's statutes on that. But if you instead leave it in continuing trusts for them, and many of you already have set these up in your trusts, then they are usually protected. Mike talked about Medicaid trusts. Educational trusts we've touched on. You can create educational trusts. I have, my first is in college now, so I'm really familiar with all the educational expenses. But one thing that you do want to be careful about, and when you set these sorts of things up, is if they're otherwise going to be qualified for need-based aid, you might ruin that with certain educational trusts. Because what the kids have to do when they go to apply for all these things, the kids and their parents, is they have to disclose all the assets or income available to them. So that's something you want to think about and get your kids or your grandkids involved before you set them up. And then inherited IRA trusts. A lot of you have those too. We call those retirement plan legacy trusts. And those protect the IRA inheritance. There's some real good bankruptcy court cases that have come out recently. The issue is, now in Florida, your IRA is protected from your creditors. It is a protected asset. The issue becomes, though, when your kids inherit your IRA from you, is it also protected from bankruptcy? The answer, generally speaking, is no. But, just like everything else, you can protect it from the claims of your kids' creditors by, instead of naming them as outright beneficiaries of the IRA, naming them instead as beneficiaries through a trust. Now, you need a special type of trust for your IRA, or else you're going to blow all the income tax planning. You don't want all that income that hasn't been taxed yet in your IRA to be taxed at the time of your death. These are all testamentary irrevocable trusts. Now, you may have noticed that what Mike and I are talking about more today, we haven't really hit a whole lot on estate tax issues, have we? But most of what we're talking about so far is income tax issues, aren't they? And that's really the whole new ball game. I mean, when you consider that the highest marginal income tax rate in 2013 is now back up to 39.6%, okay? We're going to talk a little bit today about the Medicare surtax. That adds another 3.8%. So we have 39.6, almost 40, plus 3.8, which is almost 4. We're up to 43, 44, highest marginal tax brackets, aren't we? Right? And if you or your children, most of you are Florida residents, and we do not have an income tax here in Florida, but if your children or your beneficiaries or your loved ones who you're naming happen to be residents of, I don't know, Massachusetts, New York, Illinois, what do they get to pay on top of all these nice taxes? They have a state income tax. So you can see where, even though there's no inheritance tax, without proper planning, especially with those assets that are becoming more and more common, like your IRAs, annuities, those sorts of things, you could end up, or your beneficiaries could end up, losing half of it to income taxes. So some of the name of the game with these irrevocable trusts that we're creating is income tax planning. So the first thing you have to know is that irrevocable trusts are actually separate taxpayers from their grantors, from you. Okay? You already talked about that. And what we're going to do when you're trying to understand how income taxation planning goes for irrevocable trusts, you have to understand a concept called income in principle. And as usual, when we get to the really technical stuff, I like to turn it over to Mike to try to describe. So Mike's going to hit up on income in principle discussion.
Yeah, thanks, Craig. I appreciate that. So I'll try to keep it as simple because my brain doesn't want to work this morning either. So income and principal. The issue is, what is income, what is principal? And kind of the classic law school example is the fruit in the tree. You know, the principal is the actual tree itself. It's what generates the fruit. The income is the fruit. So every year the tree, generates an apple. The income is the apple, the interest, the dividends, the rents, the income associated with the principal, with the tree, with the asset itself. A CD is the perfect example that probably most everybody here has. The CD itself is the principal. The interest that's generated on the CD is the income. So as far as, and we'll get to tax rates in a minute, but suffice it to say, what Craig said earlier is for a revocable trust, it doesn't matter a hill of beans the way that the tax ramifications are, because the revocable trust is what we call a grantor trust. Everything flows down to your personal 1040, the same as if you had it in your individual name. IRS completely ignores the revocable trust. Irrevocable trusts are not necessarily the same. Irrevocable trusts do file their own income tax returns most of the time, and irrevocable trusts can pay income taxes that I'll show you in just a minute. And so any interest, any dividends that are accumulated inside the trust and held inside the trust are going to be taxed at trust levels. The trust is going to pay its own taxes. Now, when an asset is sold, same thing. What happens when we sell our asset? What are we going to have? A capital gain or a capital loss, depending on what we sell it and how much we sell it for. Trust, when trusts sell the principal, sell the CD, or sell the real estate, or sell the tree, they're going to have a capital gain or a capital loss as well. And so we have to be very cognizant inside of these irrevocable trusts, what are the income tax ramifications? Because I'm going to skip over the next slide and come back to it in a second. I want to hit the tax rates first. So skip over one slide, because here's the rub. Here's where it really matters. For individuals, Craig mentioned the highest marginal rate, the 39.6%. Individuals don't reach that highest marginal rate till $400,000 of adjusted gross income every year. For a family married filing jointly, $450,000. That's a lot of income every year before I reach that 40% bracket. What do trusts reach it at? Can you read that? $12,000, less than. $12,000 of annual income. Trusts are immediately at that 40% tax bracket. So trusts have a much highly condensed bracket structure than individuals do. So that creates a big incentive on us to, hey, I don't want to keep this income trapped inside the trust. I want to get it out and tax some other way. So how do we do that? And I'll hit that in just a second. Just one thing to note on the capital gains and the capital losses, they're treated just like individuals are. So we're dealing on the income, not on the gains or losses. So when we're talking about the rents, the interest on that CD, the dividends on the stock, those types of things. Okay? So with that in mind, let's flip back to the prior slide, because income, if we can distribute the income each year to a trust beneficiary, that income, that dollar of income or that $10,000 or $20,000 of income is taxed at the beneficiary's rate, not at the trust rate. Okay? So it's very, very important to know. Every year, if we can help it, assuming there's no other reason not to, I want to make sure that all of the taxable income is swept out of the irrevocable trust and given to a beneficiary, whether it's you, whether it's the kids, whether whoever it is, that it's distributed out, because we don't want to get hit with that really compressed tax bracket. Okay, so in our typical family marital trust, in your revocable trust that become irrevocable for the surviving spouse, typically we have directions to the financial planner or to you to say, you know what, every year just sweep out whatever income's generated, because it's coming to you anyway. We want to make sure we pay income tax at your personal rates rather than at the trust rates. Now, income tax savings, the next bullet here. There is some planning opportunity. For most of my clients who aren't like a second marriage or we have weird issues going on with the kids, most of the family trusts that we create are what we call sprinkle trusts, which means you're the primary beneficiary. The surviving spouse is the primary beneficiary, but the family trust can also benefit the descendants of the deceased spouse. So that would be the kids and the grandkids. So we've got some income tax possibility of, if there's some taxable income that's generated inside of that family trust, and I want to pass some assets down to the kids or to the grandkids, who presumably would be in a lower income tax bracket than me, I can shift that taxable income down to them who are in the lower tax brackets. So if mom's in the 30% tax bracket and grandchild, assuming the kiddie tax rules don't apply, grandchild's 25, 26 in the 10% tax bracket, it might make sense to go ahead and distribute some of that income down to the grandkids and let them pay the tax, especially if I was going to give them some money anyway. That's an excellent way. And plus, I haven't used any of my personal $14,000 annual credit or annual exclusion. So it provides a tremendous opportunity to provide tax-free gifts to other beneficiaries, as well as provide some income tax savings down to those next generations. Because, again, we just want to make sure that it's swept out. Because another little thing that happens, not so little, but once we retain income inside of a trust, it becomes what we call a complex return, and then we've got to deal with the accountings and those types of things. So to the extent possible, I want to distribute out all of the income on an annual basis. So one other issue that's not on the slide is, why would I not do that? Why would I not just automatically make it a mandatory income distribution every year, which we could? Couple issues with that. First off, and really the main issue is for asset protection purposes. I don't want to have to distribute the income every year, because what if we're going through a creditor problem, or if we're in a Medicaid world, or some kind of problem that we really don't want the income. We don't want to take it because there's a creditor sitting here with their hand open saying, okay, you get $10,000, you just give it to me. I would much rather pay a 40% income tax than 100% tax to a creditor. And just have all that income sweep out. So for the most part, unless there's some weird issues not weird, but different issues. For the most part, we make these discretionary income trusts. But practically, usually we'll distribute it out on an annual basis, make sure that it's swept out every year. Okay?
What we're talking about here is that there are pitfalls with irrevocable trusts, but they can be avoided with proper planning. In fact, you can minimize income taxes with them better than outright distributions or outright gifts. Do you see how that works? You can also minimize income taxes by the investment mix inside the trust themselves. Certain types of investments that you might invest in or that your kids might invest in don't generate a lot of income, right? Instead, they generate growth, and the growth isn't taxed or realized until it's actually sold. So there's a lot of benefits to this, but there's some big pitfalls too. And now what we're getting to now is that this whole workshop is a big preview. Don't you just love it when you're in the movies and it's like, what, about a half an hour of previews before you get to the actual movie itself? It's kind of like what you just sat through. You sat through the whole big preview because in February we're going to give you the real meat of this whole thing, and that's the Medicare supplemental surtax of 3.8%. Keep in mind, remember at the very beginning we said that this does not apply, and these compressed tax rate schedules do not apply to revocable trusts. Okay, so all of you sitting here with revocable trusts, don't get worried. But on irrevocable trusts and even on our estates, the 3.8% Medicare supplemental surtax applies to income retained, not distributed, retained by irrevocable trusts and by estates to the extent that that income exceeds $11,950 here in 2013. Okay? So I assume that President Obama and whoever helped pass this law does not like dead people. And it's funny because he's from Chicago, where they all vote. So go figure. So basically, our next workshop in February, did we thoroughly confuse you guys today, or are you still with us? Everybody still with us? Okay, good. We tried. We tried our best because this isn't easy stuff. If you're still with us, you're doing really, really well. You know, I was in a class, I got to tell you this story. Okay. In law school, one of the classes I took was income taxation of estates and trusts. Everything we talked about today, but like on steroids. And there's only like 8 of us in the class. And the fellow who taught the class was J.J. Freeland. Do you remember, do you all remember the department store in Florida, J. Byron's? Did any of you remember that? That was his father. His father had died like a couple years before and left everything to his second wife and left him like $10. So he was not a happy camper when we had him. And there was only 8 of us in that class. And JJ taught us income taxation of estates and trusts. And I was, you know, if you guys are following us today, you're doing really well because I was totally lost that entire semester. I had no idea what was going on in that class. Because we use terms like distributable net income. If you want to look up Internal Revenue Code section 691C, if you want to try to read that and see if you can understand what it means, you're way ahead of where I was when I was in law school. All right? So anyway, I was totally lost. We're going to the final. My future brother-in-law was in the class with me. And he's brilliant. Stu Morris. He does what I do over in Boca. So if you move over to Boca, give you Stu's number. In any event, I go over to Stu's apartment the night before the test. I said, Stu, I am so lost. I'm going to fail this class. Help me. We went through the entire semester. Took us about 4 hours that night. And he went through, and then it all clicked, what he told me. There's something called a book award. It's a real prestigious thing, the highest student's grade. Guess who booked? I did. Guess who got second? He was so mad. He was really mad. I still, when we get together for Thanksgiving and stuff, I still rub that in. In any event, Stu, I guess, should be a law school professor one day. All of what we talked about today is a precursor for our spring workshop. We're going to talk about Obamacare because you got to understand the difference between revocable trust and irrevocable trust. You got to understand what happens when you pass on and how your trusts continue on for your spouse and your children to understand how the Medicare surtax applies and how you minimize that. Okay? Does that make sense? Yeah. All right. So here's just the last little tidbit I want to leave you before we start taking questions, and that is trust formalities. You know, Mike and I can draft up the most super duper cool trust that will help your family avoid all the taxes in the world to the extent possible or minimize those taxes, but it doesn't mean beans if it's not administered correctly. Okay? What I'm talking about there is, you know, if it's not followed. For those of you who ran or still run your family businesses, right? Do you remember piercing the corporate veil, following corporate formalities? Do those words ring a bell to any of you guys? The idea behind that is when I incorporate my business is separate from me. So if something happens in my business that's a liability, it's not a personal liability to me. My personal assets aren't subject to that business failure so long as I follow the corporate formalities. I file the corporate annual report. I do minutes. I file my tax return every year. You know, I do all the things that a normal corporation does. And if I don't do all those things, what the plaintiff is going to try to do is pierce the corporate veil by suggesting that we did not follow the corporate formalities. Does that make sense to everybody? Kinda? Yes. Okay. So the same thing holds true here with all your trusts. You're going to want to make sure that your family follows trust formalities in order to get all the super duper benefits that Mike and I draft into your trusts. Okay? Now, when you pass on, we help with that. We talk about, with whoever your next trustee is going to be, we talk about the things like what they need to do, how they need to file their tax returns, how they should consider the investments. We kind of give them a prep course on that. And then we also have videos that we've done of these very workshops that go through many of those formalities. And we make those videos available to your family. So, you know, so long as they have us help with the administration of your trust following your passing, we give them all those resources. That's all part of what we do. But they should know that that's important. And that speaks to who you're naming as your trustee. You all have heard this from me before. You've heard this from me before where I say, who do you want to be your trustee? My eldest son. Why? Because he'd be offended if I name somebody else. Tell me about your oldest son. He's been through 3 bankruptcies. He's been through 3 divorces. Is that a good candidate to run your trust if you become incapacitated or you die? And now you see that there's some real ramifications to that too, don't you? And we're not talking about estate taxes, gang. This is all income tax planning, right? All of us are subject to that in a worse way. So there's both opportunities for success and opportunities for failure in how the trust is administered. So that's it for today's lecture. Who feels like they can get the book award for today's class? Mike and I will stand up here and answer a few questions. Then we want to thank you, by the way. Thank you for spending your valuable time with us. Oh, some cleanup stuff. We're nearing the end of the year. You're going to be receiving your annual maintenance reviews. Go through those. Get them back to us. Now, please be patient. You know, when you say you want changes, you know, we have 700 families plus or minus in maintenance now. It does take us several weeks or months even to get through all of the changes that you request for maintenance. It's not going to happen right away. Mr. Hampton here, Blake Hampton behind the camera, one of the reasons he's with us now is so that we can turn those around faster than before, because that was becoming a problem. So we're trying to get that done for you. Also, if you have new accounts, you've opened up a new certificate of deposit, your broker has switched brokerage accounts, or you've switched brokers, please do let us know, because we want to make sure that everything we put into your trust properly back when we did it originally is still that way. I can't tell you the number of times, you know, broker, let's say broker, we'll call him Jack, he was at one firm and now he moves to the other firm. And when these guys move firms, it's a lot of work for them. Paperwork, you all get all these forms you have to sign and everything because they want you to follow them. Sometimes they forget that you had your assets in your trust when you were with them at firm A, and they go over to firm B, and now they just put them in your name jointly with your spouse or just singularly in your name. If you have changed brokers or your broker has changed firms, please do get us copies of your new broker statement. We want to look at those. We want to make sure that everything is still funded properly, as well as the new assets. Anything else to add on that, Mike?
Card?
Oh, why don't you talk about that?
All right. Your little wallet card that has the 24 access to your documents, your healthcare documents. It's been a major undertaking, to say the least, and we've had some challenges. But those are finally ready to go live. So when we send out your package here in the next couple weeks, it's going to have your new wallet card. It's going to be linked directly on our website now, and I've got to create a pretty good detailed set of instructions with screenshots and things so that it's very easy for you guys to log onto the system, punch up your information, and then download your stuff. In addition to just your legal documents, it'll have your powers of attorney, your trusts on there. It'll have a lot more documents. In addition, it's got a mechanism for you actually to upload some of your own documents if you want to take advantage of that. So I'm going to generate all the instructions, and like I said, those will go out here with the maintenance packet here in probably about three or so weeks. So that's pretty close.
By the way, one of the reasons that's taken us so long to get these new wallet cards for your health directives to you, the old vendor, we used an outside vendor for that before, and the fees were getting such that we were paying so much to that vendor that we would have had to raise maintenance fees. Well, we want to keep maintenance fees as low as possible. So we decided to spend the money to take that in-house. In other words, we had to, our website's going to be newly constructed too in the next several months, but we constructed a portion of the website now that deals with these healthcare surrogates and all those sorts of things. So now we control it and we control the internal costs of it. That's why it took as long as it did to get you these new cards. Yeah. But we're on course for that now.
Yep.
Okay, what questions can we answer?
It'll be 2014, won't it?
What will be 2014?
Well, the last one expired on March of...
Correct.
Yeah.
These will...
We'll get one next year.
Well,
it's
going to be live here probably next week, but I won't actually have the card and instructions for you until probably like 3 or 4 weeks. Probably right after Thanksgiving is my guess. And then that'll be good. As long as you're in maintenance, those cards will never expire. So it's not a matter where you've got an expiration date. The old one expired. We had to redo it every year, and again, that was a hassle. So the new ones will never expire, and they as long as you're in maintenance. So.
You mentioned, I understood you to say that when a person dies with their irrevocable trust, it's now irrevocable and it has its own taxpayer number.
Yes.
That's correct. And when I die, my wife is now the trustee. My trust is irrevocable. If it's earning money, is that earning income at 39+%? Is that?
Well, you're saying your wife is alive.
He passes away.
Oh, you passed away, and your trust is benefiting your wife for the rest of her life.
Right. But now I understand my trust is irrevocable.
It is irrevocable at that time. Yes.
The one I would point out for a joint trust, a simple joint trust,
yeah.
It might just be with all of this. Craig talked about the credit shelter, the family trust, the marital trust. Some of you have just simple joint trust, where if one of you passes away, everything goes to what we call a third trust, a survivor's trust. So again, depending on the situation, that may or may not apply. If we have separate trust, without a doubt, it's going to be that irrevocable trust for the surviving spouse.
So she has a separate trust.
Okay. Yeah.
So mine becomes irrevocable.
Correct.
That means that if she had the one trustee of mine,
Yes.
if it's earning income, let's say it's earning $20,000 a year,
Right.
is that going to be at that 39%?
Yeah. The question is, if we have separate trust and I die and I create the family trust for my wife and it generates $20,000 of income that year, is it going to get taxed at the 40%? And the answer is yes, to the extent, stay with it. The answer is yes to the extent that the $20,000 stays in the family trust. What I would tell you to do in that situation is take that $20,000 out of the trust.
Oh, your trustee will do that. Your wife as trustee will distribute to herself the $20,000.
Correct.
And it will be taxed at her marginal income tax rate.
Even though it's income that she's taking.
Yes.
Correct. Yeah, she just pays for it at her tax bracket instead of it being paid at the trust tax bracket. But she has to distribute the income out to herself in order to trigger that.
Let me give you a hard example. Okay, I die and my trust generates $40,000 of income to my wife, Patty. Patty's the trustee. Patty distributes to herself the income, the interest and dividends. She sweeps the income out of the trust account and puts it into her checking account. Okay? Now that $40,000 is K1, someone's going to pay the income on it, but it's not going to be my trust.
Correct.
It's going to be Patty at her tax rate, which is going to be lower than what the trust tax rate was going to be. So long as she withdraws the interest and dividends on an annual basis, there's no compressed tax rate schedule.
Correct.
Does that make sense?
She just needs to take the income out every year.
And by the way, you have 65 days from the end of the year in which to take the income out and treat it as a prior year distribution. So if I have, you know, one of the worries is I don't know how much income I'm going to have by December 31st. Right? You can distribute it on February 5th and treat it as a 2013 distribution if you're February 5th, 2014, because you're within that 65 days.
Correct.
Okay? So it's really not that hard. It sounds harder than it is.
If I have income coming in and I'm paying income tax on it,
Yeah.
I don't think the government cares how I spend it.
Oh, yeah, well, that's during your lifetime, yeah.
Taxable.
Okay. Well, let's see
I'll talk to you
afterwards.
afterwards.
Is the 3.8% surtax applicable to irrevocable trust for the year 2013 or not for 2014?
Is the 3.8% Medicare surtax applicable to the tax year 2013? And the answer is yes. Yes, it is. So if we have irrevocable trust and we have accumulated income in 2013, and you're above 12 grand or 11,950, we get to pay for someone's health insurance. Yes, sir. Yeah, the question is, does it apply to revocable trust? No. As long as you're alive, everything we talked about today with these income taxes and the Medicare surtax does not apply.
Irrevocable trust have to generate a tax return?
Yeah, and the question was, do irrevocable trusts have to file a tax return? And the answer is yes, to the extent I think it's the de minimis $600.
Yeah.
Yeah, if it generates a taxable or if it generates income over whatever the marginal rate is, I think it's $600. Yes, you have to file a tax return.
If it's swept out of there, you don't have to.
Good question. The question was, if you sweep the income out, Craig's example, Patty takes the $40,000 out of the trust and pays it at her tax bracket. Does she still have to file a 1041 for the trust? And the answer is yes. But it's a simple return. It says, I generated $40,000 in my trust. I made $40,000 worth of distributions out to the beneficiary, and I have zero taxable income remaining in the trust. So it's more just an informational return. But the question earlier was, or the comment I heard was, is it an all or nothing? And no, it's not an all or nothing. Patty could say, you know what, I only want to take 20 out. And she'll pay 20 at her tax bracket, and then 20 would be retained in the trust and reported on the 1041. Probably would never do that.
Depending on the trust terms.
But depending on the terms of the trust, you might have to.
Right.
So, yeah.
Anything else? Yeah, one more, and then we'll have a little round table. Yes?
Can an irrevocable trust have an end date?
Yeah, can the irrevocable trust have an end date? Absolutely. In fact, in Florida, it has to have an end date. Now, it's 360 years from now, so it's forever as far as I'm concerned, but technically it has to terminate. Usually the way we set up these trusts is what we call kind of cascading trusts, that technically the family trust is going to terminate when the surviving spouse passes away. But what the trust terms are going to say is we're going to create another trust after that for the benefit of the beneficiaries. And then when the beneficiaries die, we're going to create another trust after that for the benefit of the grandkids. But some of my clients say, you know what? At the end of the children's life, we'll just shut the whole thing down, and that's fine. So, and I've got some clients that say, you know what? I want to hold it in trust until they're, until the year. I've got one that's done like the year 2025 for some reason. I don't remember the reason, but there was some reason for that age. You know, another example is our classical minor children provision. A lot of you have kind of the stage trust for minor children where, hey, I'm going to hold the assets in trust for the kids until they're 30. And then that's when the trust is going to terminate. So yeah, there's any number of ways that we can structure the end of the trust. Okay?
When would they have to pay the higher income tax on everything they received that year?
All the income, not the distributions of principal. So if again, in Patty's example, in Craig's example, Patty takes the 40, but then she decides to take out the 100,000 of principal, that principal distribution is not taxable income to her, just the 40 that was generated.
Or if Patty sprinkles the income, let's say in my example, $40,000 of income. She takes out 20 and she gives the other 20 to our 3 daughters. None of it is subject to the irrevocable trust tax rate schedule. It's all subject to the beneficiaries' rates.
Correct.
Okay? All right, so thank you all for coming. Mike and I will stick around for more questions. We'll have a little round table after. Thanks,
All right.
thanks a
Thanks,
bunch.
guys.